welcome everybody. Today I want to run through kind of a taste of our program and hopefully give you some actionable insights into ways you can raise money more easily, some strategies around how to present yourself to investors in a way that facilitates their interest in giving you money, and then some strategies that you can implement specifically to target people who are more likely to invest in your business or invest in any startup at the stage that you're investing at. So that's kind of the strategy for today, and hopefully it's very much worth your time. As we go along, please do feel free to jot down questions into the chat for later. So I'm going to run through all the content first, and then I'm going to have Rohana's going to help facilitate Q&A later. And so just to make sure you don't forget or it doesn't get lost, if you can go ahead and kind of drip those in over the course of the presentation, that would be great. I wanted to start out with some questions for you guys. This will help me understand the audience a little bit better and maybe tweak a few things here and there. As Rohana said, we like to customize things to make sure that you're getting the most value from it. And so I'd like to start out with the first question, and you can go down to the reactions at the bottom of your screen and click yes. There's a green kind of circle for yes. So I'd love to see first, how many of you have already raised investment? It would be great to see that. So please go ahead and click yes if you have. Cool. Okay. Good to know. And then the next one, who is currently fundraising? So that would be a yes if you're currently fundraising. Cool. Yeah, you can do a clap. I guess any reaction, but if you put a no, then I'm going to assume you're not currently fundraising. I suspect most of you are fundraising, whether it's actively or not so actively. So, or you may not be here. So. And then one thing that would be helpful would be, and maybe this is better for the chat, but it'd be good to see how you're fundraising. So any details around your current strategies for raising money, it'd be good to get an idea of that. So feel free to throw some of those into the chat, and that'll help me. I can kind of address those more and probably in Q&A, and maybe talk to some of those, and hopefully some of the content that I'm about to go through will be applicable as well. So. Cool. Well, thanks for that. Let's jump right into the content. So I think one thing that's really important is to treat fundraising as a sales process, and you want to be really disciplined about it. And the same way you would be disciplined about a sales strategy, you should be disciplined about your fundraising strategy. And essentially, it is sales. You're selling your equity to people. You're taking their cash and you're giving them a product that everyone hopes will be worth much more than the cash they gave you. But it is a product and you're selling it. So you want to have a funnel, and you want to be filling in the top of the funnel with a wide net. And that means getting as many potentially qualified folks as possible at the top of the funnel. And then obviously, just like sales, all of your leads aren't going to convert into sales. There's going to be a process where some people come in at the top, a certain percentage get to the next level, which might be a phone call or a meeting, and a certain number get to the second meeting or whatever it is these days, probably more of an online or a Zoom meeting. And a fairly small percentage of those people who come into the top of the funnel end up at the bottom of the funnel. I highly recommend using a CRM, or at the very least, something like a Trello board to track your leads. And to qualify them as, top of funnel, cold lead, warm lead, and have notes in there. Whoever's working on the fundraising should be keeping track of these. You should have a weekly team meeting with whoever's on the fundraising side and potentially your whole leadership team to run through the progress of where you're at. You should have weekly and kind of monthly goals around this. So how many cold outreach, emails, or we'll talk about LinkedIn a little bit today, are you going to do per week? And how many of those cold outreach lead to a lead? So a lead would be somebody who responds back to you and says, okay, I'll have a chat, or says, I'll send you more information. and so on and so forth. And so you can do these in kind of columns, right, across your Trello board, or if you're using a CRM. We use ActiveCampaign, which is a software solution. You could use, Jira or some of these other ones as well. But I think it's really important to treat it like a organized sales process. And I think a lot of founders don't really do that very much. So that's kind of rule number one, is setting up that infrastructure so that you have a actual structure behind it. You can have scripts that you have for each level of the funnel. So obviously a cold script for the initial messaging, and then a script you would have for the first call, the things you want to run through, or the things you want to have in an email that you send your deck to, for instance, and things like that. So I think just treating it as a sales process would be kind of rule number one, and being very disciplined about it. One thing we work a lot on at Accelerating Asia is what I call here drip financing, and I'll run through what that means. A lot of startups, I think, go after venture capital or institutional funding way too early, and VCs are great because they have a lot of money, but VCs are quite slow and they offer chunky money. And so it takes at least 6 to 9 months typically to close a round from a venture capital fund and get money in the bank. You can typically get money much faster and more easily by dealing with individuals, so angels or family offices as well. And you can build momentum through these individual investments. And over time, you could raise as much or more capital and give away less equity and have a much less stressful cash flow fluctuation. So the way this would work is, especially if you're able to use safe notes or convertible notes, and you wanna try to have the documents yourself. And there's a lot of templates that you can get out there, or talk to other founders or mentors in your network that might be able to help you with that. But what you can do is you can go out and you can actually go out to individuals with a cap and a discount. And if you don't know what those are, you should. So look it up. So Google what cap and discount are. And when you're talking to investors, you can actually say, okay, let's just say you're raising $300,000 at a 3 million cap. Cap's essentially a type of valuation. And somebody says, okay, I'll give you $100,000. What do we do next? And if you have the document ready to go, you say, yep, hey, we have a safe note. It's right here. All you need to do is sign it and send us the money, and you're good to go. And you could raise, let's say, 300K that way. And then 3 or 4 months later, you could do it again, but with maybe a higher cap. So maybe your monthly revenue went from $5,000 a month to $20,000 a month. And so this time you raise another, let's say 500K, but you raise your cap because your company is worth more because you're making more money. And so maybe your cap goes from 3 million to 4 million, for instance. And then you go out and you raise another 500K. You can see how this is efficient for your cap table, or you're giving away potentially less equity, because every time you raise a new round of financing, a new smaller round of financing, you're raising the valuation of your business. Whereas if you waited 6 months and you closed that 800K, let's say, with a VC at a $3 million valuation, which is probably what it would be, because the number you start with is typically the number that it ends with. You're actually giving away more equity to the VC than you would be with these individuals. And the VC is pretty binary. It's not easy to get VC investment. They talk to hundreds of startups, and the average VC invests in about 5 to 10 deals per year. And so the chances that you're going to be one of them is quite small. And so it's quite risky for you to rely on your ability to close a VC. Whereas with with drip financing, you could talk to literally hundreds of investors. You could close 3 or 4 per quarter, and this is very realistic. And each one's giving you, 25, 50, or 100K per check. You can raise $1 to $2 million a year doing that, and you manage the process yourself, which means you maintain more control. You don't have any one investor who has a board seat usually. and you don't have anybody who has enough shareholding to really, make any decisions with the company. And VCs typically take preferred stock. They often want a board seat. They want some sort of control. And there's nothing necessarily wrong with that, because a lot of times, your interests are aligned and they're going to try to help you. But some founders especially would prefer to maintain control. In any case, doing drip financing and closing some investors at smaller check sizes and smaller rounds provides momentum and signaling to a VC that there's demand in the market for your product, and some people think it's worth something, and actually should help you raise your VC funding as well. So these things aren't binary. It's not like drip financing or VC. Drip financing can solve your short-term funding problems and also be a signal to a VC that you're getting traction and momentum with your business and investors, and it can actually make it more likely that you'll raise VC money. And so in our program, our startups raise anywhere from 3 to 500K from investors in our network, and most of it they lead themselves. I mean, we obviously help them a little bit with it, but they use safe notes. They essentially lead the round themselves, and they have enough money to make some short-term hires, maybe buy some resources, and really ramp up that growth trajectory, so that within 3 to 6 months, they're much more attractive to the VCs if that's what they want to do with their time. So I have a blog. Maybe we can post that in the chat on this topic. Goes through a little bit more detail. Obviously, in our programs, including Amplify, we do go through these in more detail, and we have some Q&A sessions as well that can help you in more detail. Cool. So top of funnel angels. Obviously there's warm outreach and there's cold outreach, right? So warm outreach is through the network, meeting people at events, getting referrals. The nice thing about once you start getting investors is they will often refer other folks to you, and that means for every investor you get into your company, you're potentially bringing in 1.5 or whatever that number is, because some of them are going to refer in folks. But obviously in the beginning, everything's fairly cold. And when it's cold, you just need to get out there. And to some extent, it's a numbers game. There's some strategy, but at the end of the day, it's like the more people you talk to and the more you just get out there and knock on doors or do LinkedIn or whatever is the value there. Let me just look at my notes and make sure I'm not missing anything crucial on these slides. Cool. So we're going to talk about LinkedIn in just a minute. So we'll talk through that. We talked through templates a little bit, tracking documents. A lot of the angel networks, apologies, my dog is barking at something, the joys of working from home. A lot of the angel networks do regular pitch nights. And so you can apply to an angel network in your geography. So in Singapore, there's Angel Central, and in Indonesia, there's Angin. And that's a good way to get feedback and potentially traction and investors into your startup as well, is through those networks. So do tap into those. And certainly you can join other pitching and speaking events. Depending upon your vertical or what your startup does, you could be a lead or an alternative to speak at an event. A lot of these events, people drop out, and so you might be able to be an alternate. And so if one of the speakers or the panel members drops out of an event at like Tech in Asia or one of these things, potentially you could be on the short list to be an alternate. And once out of every X number of times, somebody's going to get sick or something's going to happen, and you could be pulled in to be a speaker, and you never know where that leads. So that's kind of a little trick that I've used in the past. Yeah, so I think we'll talk about some of the other stuff in more detail. So I'll leave that there. So LinkedIn. So we've had a lot of startups who've had quite good success at getting investors from LinkedIn. Sales Navigator is a good tool. It's fairly cheap, I guess, depending upon what your definition of cheap is. I know startups don't have much money. I think it's like $40 a month or something like that. Maybe it's more, but essentially it's a tool that lets you filter and do outreach to specifically profiled folks on LinkedIn to get your message across to them. This is more effective for startups that are in like a specific vertical. So one of our startups that closed, I think they closed like $500,000 during the program using LinkedIn. They were in solar, and so what they did is they reached out to people with like director level titles or managing director, or people that would probably have money at energy companies. And they basically reached out and said, hey, you're obviously interested in energy. We are too. We're doing solar, blah, blah, blah. They had like their initial thing. We're looking for investors, and we'd love to, if you're interested, we'd love to have a chat. And so it's really as easy as that. And you can use LinkedIn Navigator to do your filtration, to come up with a list of folks and fairly efficiently do your outreach too. You can also search by people who have angel investor in their title. And then a lot of tech executives like to do angel investing. So you can kind of target people at, the big ones that you've all heard of. But the ones that seem to be the most effective are people who are overlapping in the vertical. And there's just an obvious knowledge base and interest beyond just the money that these people have. And they could also be good mentors. They could open doors for you. They might be customers. There's a lot of potential advantages to that. Ex-founders are good too. So if you know any founders that have exited or can get access to them, founders who've exited typically like to reinvest back into the startup ecosystem, and they would be a good potential target for you as well. And then like we've said before, you really want to be efficient with this. And so once you do have an initial outreach and there's been a positive response, you want to make sure you're tracking that and move that over to your CRM or Trello or whatever you're using, and make sure that's all documented. And then you want to run through that weekly and make sure you don't miss any chances to engage with them. You should have a pitch deck ready. You could have a data room ready, at least a basic one, and you can do some research on that. We go through the data room and some other things in our Amplify program as well. And the case study, I already talked through it. The case study was Energy Light, which is a solar company. But we've had a number of startups in this cohort that's going on right now, and previous cohorts as well. And so this is a nice kind of hack. If you have access to Western markets, especially the US, you might do something similar through AngelList, which is another platform, not so active here or as useful here, but quite useful for the US. So that's LinkedIn. So closing investors is really a matter of three major things. So number one is your communication. Are you effectively communicating your business in a way that's going to generate excitement? It's very clear, and otherwise, you come across as very professional, that you really understand the problem, and you can convey that you are the best team, or if you're a sole founder, the best founder to be doing this problem. And so there's a very large marketing aspect to this, and it's marketing as the problem is big. The time is now, and we're the team to do it, and we have the right solution. And so those are really the major parts of the messaging that you need to convey to a potential investor. Momentum's really helpful. So often people want to see that, where were you 3 months ago and 6 months ago with your metrics? And so that could be revenue, it could be number of users. It really depends upon your business. Where are you now? And where are you likely to be 3 months from now and 6 months from now? And so you really want to understand, like, what are the key numbers that are important to measuring your business? You obviously should know those yourself and be able to rattle those off if there's a question about it. So you should know literally what are the three most important numbers that your business needs to be on top of, and what were those in the not too distant past, and what are those going to be based on your forecasts and projections. So momentum's important. And then price is your valuation. So are you attractively priced so that people will buy your product? You really want to do research and make sure that your price isn't too high or too low, right? You might even take a low price just to get the deal done, because you do have an opportunity cost here. Your opportunity cost is you're spending time raising money or you're spending time growing your business. And if you're kind of stubborn to have a high price, you might get it, but it might take you twice as long. And so what if you had a lower valuation and you gave away a little bit more equity, but you had a lot more time to spend on your business and growing your business? Is that a better use of your time? Maybe, maybe not. But I think it's really important to do that analysis and say, okay, we think we could raise at 3 million, but it might take a couple months. Or we could try for 4 million, but it might take 6 months. Or we could do 2.5 million and we could close it really quickly. And so you kind of need to do your own analysis on what you think is the best option. I typically think that it's better to take a little bit of a lower valuation in the early days, get the deal done, build momentum, use that money to reinvest in your business and generate higher growth, because that's going to pay dividends later. And you might actually end up giving away less equity later because you're able to build the business quicker. But certainly it's up to you, and you're the founder and you're the owner of your business. You need to decide what's the best strategy for you. The last bullet point here is also important. So I meet a lot of founders, including coming into our program, that say, hey, we're raising $1 million. And I usually say, okay, that's fine. That might take you 6 to 9 months. Why don't we do this? Why don't we raise 300 or 400K in the next 3 months? And kind of what I talked about before, you use that to reinvest in the business and make some key hires and maybe, launch a marketing program, build big momentum and generate organic growth and have a healthier cash flow. And then raise that million or maybe even more than $1 million in 6 to 12 months. And that's how long it's going to take anyway. So in the meantime, instead of saying, I'm only raising $1 million, why don't you raise 300K now and you're raising another $1 million 6 months from now? And then with the 300K, some people say we're raising 500K, but that might be hard. If you raise 300K and you end up raising 500K, then guess what the perception is? You were oversubscribed. But if you say you're raising 500K and you only raised 300K, then you didn't meet your target. And so, over-index on, a lower fundraising target so that you're more likely to be perceived as being successful at closing a round or being oversubscribed. And so Energy Light, we went out with a 300K target and he ended up raising 500K. And that was great. We in fact had to turn some investors away and tell them they could not invest in the current round, but they had to wait till the next round. And that was, the more you tell investors they can't invest, the more they want to give you more money, which is another funny psychology aspect. But anyway, so this is great messaging right here. We're raising 300K. We have 200K committed. Our minimum check size is $50,000. There's room for 2 more investors in the current round. You're building massive FOMO there, right? Because it's like, oh, okay, they're 2/3 committed, and only 2 more people can get in. If I don't invest now, I'm going to miss this opportunity. And so as much as you can kind of message things like that, it'll just give you a quicker path to getting at least a yes or a no. And I think for the most part, it'll lead towards people being more likely to make that decision quicker, and it'll help you fundraise faster. And so anyway, these are just a few little tricks and or just kind of insights into early stage fundraising that hopefully can provide some value. And I kind of wish I'd known this when I was a founder. I went after the VCs like way too early. Okay, so VCs. So we talked about angels. Most of you probably should be focused on 80% on angels and 20% on VC. But that doesn't mean you don't meet with the VCs. Obviously, the VCs have money. They can be really good signaling for the market. They can introduce you to useful people and companies and all sorts of things. And so you certainly can keep talking to VCs, even if it's unlikely that you're going to get investment from them in the short term. They can give you very valuable feedback, and they might invest in you later. And so keeping that relationship is good. But keep in mind, most VCs are targeting about $1 million check size. And so if you're raising 200K, very few VCs are actually going to invest at that stage. So just, be realistic about that. And in order to qualify for $1 million check, your valuation should be at least 4 million. More likely, it's like $7 or $8 million. And that means your monthly revenue should be around $50,000 a month in order to qualify for $1 million of investment. And so just be realistic about where you sit from a maturity aspect of your business. Because if you're below this, chances are you should be raising angel money. Now, if you're really good, a VC might give you a small check because they want to be on the cap table for next time. But for the most part, this is exactly how it works. And so the VCs is really about building relationships for later and getting good feedback. And that's why it's a bit Pareto, and you should be spending about 80% of your time talking to angels and maybe some family offices. And like I said before, if you close some of these angels and individual investors and family offices, it builds momentum. And that's a really good signal to the VCs to show that there's market demand for your product or your equity. So that's another one. And then lastly, some founders seem to think that talking to analysts at VCs is a waste of time. And I think that's definitely not the case. The partners at a VC fund are very busy. And they cannot make unilateral decisions anyway. There's an investment committee, there's a process. So often, even if you do get a meeting with a partner, he's going to refer you back to an analyst. And so analysts can be really useful. Analysts typically get compensated based on how many deals that they source and get through to the investment committee. And so they are your champion internally. They have direct, usually financial incentive to get their company to invest in you. Nobody else in that firm is typically going to have as much motivation to get you money from that company as the analyst does. The analyst also can usually give you very good feedback, and they can coach you on how to sell to their firm and get through the investment committee. So I would definitely recommend taking meetings with analysts, and don't think that a partner going straight to partner is like the only way to do it or the best way to do it. Most of our startups that have raised from VCs went through the analyst level before they went to some of the other levels. So anyway, so that's that. Another kind of trick here is often our angel investments in our startups come from mentors. And the relationship actually did not start out as an investment conversation. It started out as a mentor conversation, and then it led to investment. And this could tie in with your LinkedIn strategy. So you could actually reach out to some of your mentors, some of the investors or potential investors on LinkedIn that do have, overlap with your vertical, or there's somebody there that could add value. And you could start that conversation as, I would love to talk to you and get your advice on our business. And that's it. You don't have to talk about investment right away. Sometimes it's actually better not to, because then they feel like it's kind of a pressure environment where they need to decide to invest or not. Whereas if you ask for advice, it's maybe more likely you'll get the meeting. And then if they really like you, then you can obviously bring up that you're fundraising, and then you can have that conversation in tandem. So this is kind of a quote. I don't think it's like 100% true, but there is something to it. And I think it's useful to keep this in mind. And it's another tool to use when you're talking to somebody, if it might be easier to get traction with them if you just ask them for advice. So that's that one. One thing all of you should do if you're not is a monthly update. And it doesn't even have to be an investor update. It can be just a monthly update that you send out to a database. Definitely use a CRM tool or an email client that helps you send out a lot of emails efficiently and cheaply through a template. You're going to meet a lot of people that say no, but usually that means not now. And momentum is really important. So if you meet somebody and then a week or two later they say no, they haven't really gotten to know you very well. They've only gotten to know a little bit of information about your business. if you send them monthly updates where they keep seeing, oh, we signed this new customer, our revenue is increasing, we're hiring, we just raised, 200K, we only have 100K left. Like, all this stuff can be in your newsletter. Excuse me. And oftentimes the newsletter can lead, excuse me, to new business, to referrals for mentorship, and certainly to investment. And so I think monthly newsletters are a must. We actually require all of our startups to have monthly updates. It's useful for us as well as investors. So even after you get the investment, keeping the investors informed about what's going on in your business, both good and bad. And in your monthly investor newsletter, or just your monthly update to everyone, always have an ask. And so an ask is like, what do you need as a company? So it could be fundraising, it could be other things, but you hopefully will have hundreds and eventually thousands of people on this. There's got to be somebody there that can help fill a gap that you have, or introduce you to somebody that you need to be introduced to, or that will invest or knows people who might want to invest to fill out the rest of your round. And so don't miss that opportunity to do that. And from a format perspective, keep a summary at the top of the fold. So all the basics are there, and then you can have the rest of the details lower in the message. And this is something that we work with our teams on, and we cover and amplify in our core program as well. Okay, so now that we're in a COVID environment and pretty much everything is remote, it's really important to get your presentation correct. So think, if you were going to meet somebody in person, you'd probably take a shower. You probably, wash your hair and maybe, make sure your hair looks good. You probably dress appropriately. And, you'd make sure, excuse me, my throat's going this afternoon. You'd make sure that you have, you got some good night's sleep the night before. And otherwise you'd prepare a lot to make sure that this meeting goes well, right? For some reason, a lot of people don't give the same effort to their Zoom meetings, and they have bad lighting. They're dressed sloppily. Their audio is funky, whatever the case might be. And so pay a lot of attention. I think whatever I'm doing right now, I think is pretty good. I wasn't good in when I first started in COVID, I didn't pay much attention to it, but I've gotten much better. But you can hear me. I actually bought an external speaker that has much better sound than an AirPods or a lot of other things. I have my computer on a stand so that it's at eye level with my face, and that's just much easier for people to consume. And my lighting is pretty good. So I have an overhead light. Some people have one of these circular lights that kind of faces you. That's even better, but you don't have to spend a lot of money on these things. And then what's in your background? So I obviously have a fake background, but some people don't, and you don't have to. But make sure whatever is in your background isn't like looking messy or distracting or whatever, and just make sure that it's clean and clear. So these are some of the bullet points. Obviously, you want to look at. You don't want to be looking down at your camera. Typically, that makes you look less attractive, and kind of messy. And then, obviously you want to have good lighting, and then audio is really important. I can't believe how many founders show up and they're just using the computer audio, or they have some broken mic that doesn't work very well. Try not to take calls from a cafe where there's a bunch of background noise that makes it hard for you to have a conversation. And do your best to have a secure connection. If you're calling from home, I would highly recommend getting an Ethernet cable and not relying on Wi-Fi. Especially if you're in like a country where the internet might be a little spotty from time to time. So these are kind of some tips. And I think we have, here's some examples. This is real. This is from a real phone call. And Rahana's done a great job of putting green crosses where people are doing a good job. And luckily I was doing an okay job today. I don't think it was even great, but it was okay. And you're seeing some red where there's some not so great stuff. And so the one on the left, if you look, the founder here, it's hard to see him because the lighting is funky. So he looks really dark. He's looking down at the camera. The lighting obviously isn't great, and his audio wasn't working, if I recall either. So these are some kind of examples, and obviously try to do what the ones in green are doing. Angia at the top is the woman fourth from the left on the top. She's great. So she's got her startup on a wallpaper in the background. The lighting's like perfect. You know, she's centered with her head. You want your head to be right about where I am now, right? So you don't want to be like this. That's weird. Like, where's the rest of Craig's body? And then and then you don't want to be like, some people are like all the way back here, and that doesn't work either. And this is important. It might sound superficial, but especially when people don't know you, first impressions are how they're going to judge you. And so if you came very prepared with good lighting and good audio to your chat with the investor, they're going to say, oh, this person, at least in their head, they're going to say this person was really organized with their call and everything, and so they're probably going to be just as organized with their business, and so it does rub off on their reputation or their kind of judgment of you, and whether that's fair or not, I don't know, but it happens, and so you need to be prepared for that. Okay, so that's kind of the content piece. I hope you guys got a lot of value from that. If you are interested to dig deeper, we do have a program called Amplify, which we talked about, which is similar to what we did today, except obviously we go into a lot more detail on fundraising, on growth, storytelling and pitching, which I think is one of the most important aspects of running a company or a startup, and is not focused on very much by a lot of investors and founders. Metrics. So we talked a little bit about metrics, but we dig a lot more deeply into which metrics you should focus on, and how to measure them, and et cetera, how to talk about them. And then recruiting a team, which is extremely important, obviously, especially with the competition of trying to hire developers and other good people. And so how do you do that effectively and efficiently? So anyway, so here's a code that you can get a discount. And I think we're starting pretty soon. I think we're starting next week, and I'm going to hand it to Rohanna in a second, and she can talk about it in more detail. So if you do want to join, we already have a bunch of startups that have signed up. Would love to have you join as well. We do live sessions as well. It's not all video. And so you do get to have more time with me, and some time with Nash and some other folks on the team as well. I think just as importantly, we build cohorts, and we have a Slack channel, and you guys can ask each other questions. You can share resources between each other. And the cohort effect is one of the most powerful parts of an accelerator program. And so you don't have to be in our core program, which is quite hard to get into. You can get a lot of these assets through the Amplify program as well. And so I think it's really, really valuable. I wish we had something like this when I was in my early days as a founder, because I was really bad at a lot of these things. I had to learn the hard way. Anyway, there's my pitch, and would love to see you be a part of Amplify.